Good morning. This is Jim Colburn of Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website at commodityresearchgroup.com, where we post our podcasts. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any specific trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. It's September 11th. Crude oil market, WTI is up about $1 today, bouncing off a down day yesterday, a down week, a down month. October, WTI was at 82 back in July. We're now at 66.8. And I'm going to just hand that setup over to Andy and say, Andy, what the heck happened?
Thanks, Jim. And yeah, it's been quite the couple of weeks here in the petroleum market. And, when you have a big down move like this, there are certainly a lot of factors that contribute to it. And we'll start with the fundamentals of both supply and demand. But I think that this latest move has really been fueled by, on the demand side, the market since I'd say since May or June has been obsessing about demand and worrying about what was happening in the U.S. and China and Europe. And as we got closer and through the summer, it became very apparent that demand was nowhere near some of the early predictions for the year. In particular, OPEC, the OPEC research group, who puts out a monthly report, has been taking a lot of heat for being way off the mark. They were talking about demand growth of over 2 million barrels a day this year. And some of the other forecasters were looking for demand growth maybe of 1.5 million, while others were were up over 1 million. At CRG, we weren't that optimistic all year, really, Jim. We were, maybe 1.2, 1.3, and now we've slashed that to under 1 million barrels a day growth. And the reasons have been the US and China. These demand numbers have just come in so soft, particularly in China. OPEC thought China was going to grow, I think, 700,000 or 800,000 barrels a day. The EIA just said they thought China would grow only 100 to 200,000 barrels a day. And, we're at 200 now, and it wouldn't surprise me by the end of the year if we go to flat or even below last year. So a lot of the worry about demand came to pass, and that set up the beginning of what has become very bearish sentiment to, in the market, where we've seen, as you mentioned, Jim, prices just continuing to unravel. Now, part of that on the unraveling was when you come with sentiment, bearish sentiment, you certainly start seeing that in the commitment of traders reports, particularly on the WTI side, which was actually a little long. Very long, actually. They were 8-to-1 long a few weeks ago. They're now 3-to-1 long. These are large money markets, and they're probably 2-to-1 or 1-to-1. Brent is only 1-to-1 long now after having been much longer. So you also have the you have the fund selling along with the consistently bearish sentiment. And on the supply side, that's more of expectation, I think, than where we are currently. I mean, inventories have been building. I don't think they're short by any means. I don't think they're really all that long by any means, actually, as evidenced by the backwardation we still see in the front. But as we do our balances looking further out, it looks bearish if OPEC is going to unwind its production cuts. And I think again, looking at those supplies or looking at the balances, you see first half, second half, at least for CRG and also IEA, not so much for EIA. You see fairly significant supply increases, surpluses. We've got 500,000 to 1 million barrels a day next year. So does the IEA, and that again, that inputs into expectations, which we've seen in the curve. I know we're going to talk a lot about the curve later on. So you have these very basic fundamentals, Jim, right?
Right.
Really.
The market works.
Yeah, sometimes the market works. And then you have, I think, it wasn't like a lot of banks or any banks or any of the, forecasters were looking at mid 60s for WTI earlier in the year. That just was, people were talking 90s. You
Right.
had some of the major banks talking prices, Brent and WTI into the 80s and 90s all year. So those expectations too were dashed. And then finally, you start wondering, okay, is this going to be a major move down because OPEC Plus is the Saudis, I should say, are changing their philosophy and just going for much lower, going for lower prices next year, that they are going to do the unwind no matter what. So, you throw that into the mix and whatever other big macro you want to pick, you have prices here in the mid 60s.
It's interesting. The EIA's report that came out yesterday showed OPEC plus production this year, you know, oil production, liquid fuels minus 1.4, while non-OPEC plus is plus 1.7. So they're they're trying to maintain price, but they're losing market share. It's I think I've heard this tune before, Andy.
Oh
And
yeah,
and
we've heard this too.
if
Right.
that goes on for so long, the Saudis get upset, or in the past, and they will produce more and trash the market. You see that any you see so the question is, we've had this move down, sentiment's bearish. I'll get into options in just a second. But I mean, do you think that's on the table for them?
Well, it actually, yeah, they have to look at, I guess they've got to figure out, is this the beginning of the major move down? Because, if you look at 2024 so far, before September, before this week, the average price has been 83.50 for Brent and
Right.
79.50 for TI. So they've actually had a decent year up until now. So, I guess they have to, they'll do their own analysis. But yeah, they've done it in the past, Jim, as we've mentioned, where they said, all right, we're just, part of the main reason the balances are looking so bad, as you just mentioned, is you have these big production increases coming from non-OPEC, coming from the US, Brazil, Guyana, Canada, and these increases, unless demand really booms next year, which looks unlikely, these non-OPEC increases mean that there's no real room for OPEC to increase production. So I'm sure that the Saudis are thinking, all right, we've lost all this market share. Do we just take 2025 and into 2026? And Jim, I know we've talked about the good sweating,
Yeah,
which has been a term that comes out every now and then when the Saudis decide, okay, it's time to shake these non-OPEC producers out and do some damage to do some damage to the shale producers and some of the yeah, do damage to the U.S. shale producers and whoever else. And that leaves us with a pretty clean, a pretty good look at 26 into 27 for higher prices.
interesting. The all the bearish stuff. I just want to give you a quick rundown of what we've seen in options, and it's not really that interesting because if you've seen a price move down like we've seen, you would expect implied vol to go up, and that's what it's done. And we early July kind of was the low at 20.8, and I remember we were talking about how this is crazy to be that low. I figure in my head, the long-term average is around 33, 34%. So we're really below the long-term average with a lot of uncertainty in the marketplace. But the market just wasn't moving around that much. And so implied followed the market down and got to 20.8. And yesterday, October vol settled at 41.8, which is a hefty number, but it's only got a week to go. So, you get a significant amount of buying in the front month, and it'll blow it up pretty quickly. So I tracked the second nearby, which would be November right now, and that's up to 36.8. So that's a big move off of July low, but it's still a little bit 33, 36.8, just a little bit above average. So vol has moved up. You would expect that. The skew has gotten slightly more bearish. Oil is always, not always, but its natural state seems to be showing a bearish skew, which is where the put implied volatility is above the call implied volatility. Got that moved a little more to the bearish side, which you would expect. And also if you looked at the actual volatility, like the historical volatility, that's also moved up. So the actual market volatility moved up, implied volatility moved up. The only thing I might say is that yesterday we had a significant move down, and one of the on the put side, the D60 put in WTI and in Brent together probably have the most open interest. They traded. They were the only two options yesterday that traded over 10,000 lots, which is unusual on a big day like that. So they were like around a little over 10,000, but their open interest didn't move. It actually was unchanged and moved down a little bit. So on yesterday's move, we've kind of been in the option world. Like I said, a put volume has gone up, call volume is up. Put volume's gone up relative to the call volume, but it doesn't seem like it's this crazy, expectation for significantly lower prices. So I guess you don't want to make too much of this, but it still has this trading range mentality, I think, in it that,
Mhm.
so we'll see. I don't know. We're up today in a bounce. And the other thing is, you have all that fund selling, and they're probably, you got to probably rip some faces off here, I think. But where's the fundamental piece going to come from? So I guess that's the question: is we've hear everything you read is bearish, the sentiment is bearish. Is this move already in the market, or do we have more to go down? And
Right.
that's and
And
so can I change direction a little bit? But we want to talk about further weakness in the market. But you we read the EIA monthlies, good source of information, and kind of a base case for us, along with the IEA and OPEC's monthly oil reports. And the EIA opened up with a little blurb on biofuels and specifically biomass-based diesel. And they're suggesting, or their estimate is that distillates demand is going to be 4.1 million barrels a day in 2024, and 9% of that is biofuels, 360,000 barrels. And most of that's in California and the West Coast. How significant is that, Andy, I mean, is this what's punishing the diesel cracks?
Yeah, I think it's there are two major factors on the diesel cracks, which for all it's still at $20 is still not horrendous. Actually,
Right.
those are not those are not horrible numbers. That's the NYMEX New York Cushing Cushing crack. It's not horrendous, but nevertheless, I think there are a few factors with the global weakness of diesel, which has been pressing on refinery margins, and mostly in Asia and Europe as well, and here too,
Mhm.
here too for sure. But not only are we losing petroleum-based diesel to biofuels, and that's going to continue to grow over the next 3 to 5 years. But we've also lost demand to poor manufacturing sector.
Mm.
But we've seen the ISM has reported 21 out of 22 months of contraction. And manufacturing is key to diesel demand because we manufacture goods and then they need to be distributed. And they're distributed by truck and rail and, the diesel, diesel consumers. The other factor, and this is similar to what's been going on the West Coast, is in China, diesel's being displaced by LNG, and it's something like 8 to 10% of China's diesel demand is now being displaced by LNG by trucking demand that are powered by liquid natural gas. So that's another 300,000 barrels a day. So there's 650, 700,000 barrels a day of petroleum that is being displaced by alternatives. And we're not getting that back. So, that's a critical factor to demand, to overall petroleum demand growth, crude growth, really important factor for 2024 and beyond. And then, of course, we have EVs, which are substituting gasoline demand. One of the trading houses, one of the heads of one of the largest trading houses said that he thought that gasoline demand had peaked in China,
Wow.
and because of the growth in EV demand. Now we're seeing, EV sales have slowed, but certainly on gasoline, that's EV sales here in the US, I should say, because China, there's still, they're still increasing at a decent pace. Here they've slowed somewhat, but they're still coming. And we've seen gasoline demand this summer is probably off like 5 or 600,000 barrels a day from the summer of 2019 before the pandemic. And even though a lot of every holiday weekend they said, oh, the AAA would say it's record demand. Our demand growth this summer was underwhelming. It's probably going to end up flat to up 50,000 barrels a day, which sort of again, it's mediocre. And also forget, just talking, getting back to gasoline, engine efficiency, as well as working from home are other factors that are cutting into gasoline demand. So, and again, and let's get back to the market, and market pricing.
Right.
This is all, being discounted. It's making a move now, but we've been talking about this now for years, Jim.
right. Yep. And definitely seeing it in the numbers, which is interesting. Um,
Yeah, now it's coming. It's coming to fruition.
and now we have refining capacity. I'm looking at Nigeria with this. I don't know if I pronounce it, Dangote
Dangote,
refinery.
yeah,
650,000 barrels a day,
yeah,
50%
it's a monster,
gasoline.
right?
I mean, I understand they want to take their crude and process it and get that value added, and that would certainly cover their gasoline imports. But is what's world refining capacity look like? Is it's going to be under pressure? Are we still building refineries? We're shutting them
Well,
down. We're building them. What's
I think the global capacity, I don't have the numbers in front of me, but this year, because of Dangote and also the big Mexican refinery that still is not, still not up. Neither one of them is up to capacity. So we're still growing. There's still some new Asian refinery capacity. And the question is, how much more refinery capacity are we going to need? There aren't any big projects on the boards right now. So I think we're going to start seeing capacity also peak with demand. And ultimately, we're going to have to see refineries close because probably in Europe, because that Dangote refinery, think about this. Europe would send to Africa, would send to Nigeria.
Mhm.
So all that gasoline into West Africa isn't going to be going to West Africa. It's probably going to be coming here.
Right.
Or, the capacity is going to have to close in Europe, then it'll go nowhere. So, and Mexico as well. I think you're going to see these flows really change over the next couple of years, and that should be good for the U.S. consumer, I would think, particularly us here in the Atlantic coast, Jim.
Yeah. As a as I get a hybrid, I don't. I'm one of those that don't. I don't use as much. First of all, I don't drive like I used to, and I don't. I have a more efficient car that I drive. So, I mean, lower gas prices are not gonna. It's not gonna be like the tax break that it used to be when we first got into this business.
Yeah, that
Um,
that that's true, but it's definitely helpful to
yeah. Oh,
see, and we're
no,
seeing that. I mean, look at these,
no question. Okay, it's just we still
we're
haven't.
we're seeing across the country. A lot of states now have a two handle on 87 grade, on regular gasoline, so under $3, and that's, I think that's welcome.
Well, we had a conversation with a friend of ours, it's kind of like a Zoom call with some oil traders, and maybe about, I don't know, 2 or 3 years ago. And I asked the question, if you could be in any part of the oil industry, which one would you pick? And they all picked refining. And we had a follow up in recently, and nobody picked refining. One of them said, "I'd like to be in the Afromax part of the
London
market."
shipping, right?
Yeah, the smaller ships though, not the VLCCs. 'Cause I guess they're in demand right now. So refining capacity, where do we want to go from here, Andy?
Well,
What? Yep.
I
Go
think we want to go. This is a question that you have been asked many times over your illustrious career in the options world.
Oh boy.
And the the question is, if I'm a producer and prices are down here and I haven't hedged, what should I do?
Yeah, that's you're right. We would always get those questions after the market dropped 15, $20. Now what do we do? And for some reason it would be someone who didn't have options in their playbook. I'm thinking, well, let me see what we got going there. And obviously options are also feeling the effect of lower prices. So I guess what we used to tell them was the answer was no answer, but depends on what your risk profile is. And producers tend to have a little more cushion on their cost of production to where the market is. So you probably would want to buy some puts, even though they're expensive and prices have gone down. But if you're in survival mode, that's probably what you want to do. Selling futures gives you today's price, which would be better than an option price because typically you buy a below the market price put. And only problem is if you're selling out to 2025 and the market rallies from here, you've got a lot of margin money to come up with. And yeah, that could be a problem, especially if there's some geopolitical event, some barrels taken off the market. Look, we just saw Libya lose a bunch of barrels. What if it happened to a major, you know, Middle East producer or anywhere else, hurricanes, stuff like that? Then with futures, you have to put up mark to market payments on your margins. You could do a put spread, reduce the cost of the put. Also doesn't give you as much protection should this market really start to unravel. And, if we go into a recession, that kind of stuff. You could do the old three-way, selling out of the money call, buy a put spread, sell, do the fence, selling out of the money call, buy a put, stuff like that. Gives you a little more, reduces your payment on the put. And when you sell an out of the money call, at least you have a little cushion for like a short covering rally before you start getting into your the strike price of your call that you sold, which is where you might have to sell your oil. So there's stuff like that you could do. However, it's really great to talk to somebody like our buddy Andy Furman and have a plan in place. So you've already done at least some of the barrels, and you've got a little protection on already.
Right.
But that's yeah,
Right. The real answer is, well, you
stay,
can't really say where were you when it was trading $80, or
right.
90
No, it's that's
earlier the
no,
year.
it's yeah,
But I think that goes to your point that, you need a plan.
yeah. You need a plan. I mean, we had those stories where the hedger, the person who was in charge of hedging would go into the meeting and the oil company, this is a true story, oil company made money in every single group except for the hedging. And so the, the, the top people of the company said, well, what's wrong with you guys? You're the only one losing money. And, that's what they're supposed to do. I mean, that's
Right.
what, and this particular person said, you're asking the wrong question. You should be asking why we didn't lose more money because we were underhedged. So I think most oil companies are pretty much know, they understand risk much better than we got into the business, and they have plans and they know how they want to deal with it. I mean, in different degrees. And also the strength of balance sheet. If you have a strong balance sheet and you're an efficient producer, you might be able to ride out most of these cyclical moves in oil because the oil price goes up, oil price goes down. So, if you may not have to hedge if you're going to be the last producer standing type of thing. And I think, we see different degrees of efficiency in producers as well. So it's an interesting conversation to have with hedgers. And
And
yeah,
we certainly have had it.
yeah, we've
We had
had them. Yeah,
every time the market would hit new lows, those conversations would, pop up.
well, when you ask me that question, it brings me back to when we sat on the desk and we had these conversations,
Yeah.
and also it reminded me of one of the OPEC ministers. I think it was the UAE, where they weren't comfortable with futures markets, and they actually didn't like them, and we finally felt like they were being accepted when one of the ministers said, "Don't believe those numbers you see on your screen." And because it kind of told us, oh, he's finally got a screen on his desk. He's watching these futures markets, so he's, grudgingly accepting that this market's important. But yeah, Okay, so what's the question, Andy, to you is all this bearishness in the market, are we overdone? And what's gonna take to get this market back up and some of the short covering off the table? Because the EIA really was forthcoming with their oil prediction, and they were kind of saying that they were seeing inventories declining. I think they have it minus zero point 0.9 for 2024, and also into the first quarter. And they're
Right.
kind of saying that will get this market, and they're talking about Brent back up to $80. I believe it was $80, but
Right.
rally back up.
Right. I thought the EIA was actually pretty bullish.
Yeah, that's what
Uh,
I'm saying. Yeah, definitely.
yeah. But
Or you mean more bullish than you are? Or
well, yeah, more bullish than I am. I'm again. Let's talk about short term and longer term.
yeah,
Short term, there are definitely some very bullish developments. The first one is Libya. Their production is down by 600,000 barrels a day. The EIA said, and this caught me a little bit by surprise. The EIA said that they would be down for the rest of the year, could be down for the rest of the year. And
yeah,
I think the market was saying the market is using end of September or maybe into October, but you take 600,000 to 900,000 barrels a day, which some people say it could be down for till the end of the year, that really changes the balances and does allow for an increase by OPEC into the fourth quarter. Now, Libya is a wild card. We don't, who knows what they could be up tomorrow, but usually these shutdowns are longer than what you think.
right,
So, that's something definitely to keep an eye on. Number two, we'll see what happens with this tropical storm, hurricane now, Hurricane Francine. It's already taken out a third of the production in the oil production in the Gulf Coast. We'll see how quickly, that production comes up. And then, of course, whether or not there's any refinery damage and, whether or not these again, that needs to be played out. So, there's definitely, those are two bullish factors right off the bat. And of course, technically, as you mentioned, Jim, we've really come off fast. So the market is oversold. Longer term, one of the reasons the EIA is so bullish, besides the Libyan factors, they have big demand for next year. I think they're looking for something like up 1.6 or 1.7 million barrels a day for I have for 20 for growth in 1.5 for 2025 growth.
right,
And that's if that's the case, and the first half is stronger than we have. We're up about a million for next year, and the IEA also in its last report was up about a million barrels a day. That 500,000 barrels a day, that's a big number, and it'll allow a more orderly unwind by OPEC, and could keep prices steadier, steady, maybe even higher. And of course, as we talked about earlier, where are the Saudis? Where are the Saudis going to go? Are they going to, do they want a full unwind? Do they want to keep prices higher by not unwinding as the plans were? They're under pressure not only fiscally, but also, the UAE and Iraq have spare capacity that they've spent a lot of money on
right.
building over the last few years. So they're going to, they want to use that spare capacity. So, they want to increase. The UAE worked out a deal where they're going to be allowed a 400,000 barrel a day increase next year. Whether or not where that goes, I guess it'll be price determinant to a certain extent. And Iraq too, they have spare capacity and they want to increase production. So, they've been overproducing relative to what their target is, but nevertheless, they want to increase production. So, and the Saudis, they're down a million. They've cut the most. So they've got some real challenges next year, particularly if demand is not, if demand grows from like 500,000 to 1 million next year, that's a real challenge.
Can you talk about Iran for a minute? If is Iran's production going to have be dependent on who gets elected next year? Well, if Trump gets elected, is he going to try to take their barrels off the market?
I'm sure he'll try to tighten things up because they've been fairly steady. They've been fairly steady. Let's see, they've been actually they've been steady around 3.2
Hmm.
these last 6 or 7 months. 3.2 million barrels a day, 3.2 to 3.3 million barrels a day. And the sanctions have really not, they haven't been policed as hard as they could have,
Right.
probably to keep prices under wraps somewhat.
Yeah.
But yeah, you would have to think that Trump may want to police them a little bit harder and take some of the Iranian barrels off the market. But again, if that's the case, then prices, that could be bullish for price. But I guess early on in his term, it's less of a factor than it would be later on. The other thing, Jim, is one would have to think that we're going to be looking to buy more for the Strategic Petroleum Reserve.
Right.
Um, that was a great trade by Biden.
Well,
I mean, a tremendous trade.
I see he's getting a lot of calls from the trading companies. So something to do
That's his
when
next.
when he
That's his
retires.
next. That's his next job. He may be. He may be good for trading oil. Who knows?
So, one of the things I didn't mention in options world is that we have seen significant more volume in the spread options. And I don't get a good sense of who's doing what in those things, but we're seeing we saw some $2 calls trade yesterday. I mean, obviously there's a buyer and a seller. I'm guessing the initiator was a buyer. And then we're seeing zero struck puts trade. Yeah, do you have a sense of where the spread might be headed? It's obviously come off its highs. You mentioned it's still we're still backwardated. Is that right?
Yeah, we're still backwardated in the front. A lot of the backs, I mean, have really flattened out. Like these red D's. Last I looked was trading like around 80 cents. That's eight
Mm,
cents a month.
okay.
And some of the other back months are more towards flat, which makes sense because the market is expecting a big surplus later in the year. Given everybody's balances. I'm sorry, a surplus in 2025,
Right.
although the EIA has less of one. Some of the other like we have a big surplus, as does the IEA, so it does make sense that the spreads would flatten out. I think if Libya's off more, that there may be some, the market you know, could hold in here and the front end anyway and rally. And Cushing, of course, the supplies are really low, but they definitely will rebuild as we head into turnarounds. And turnarounds should also tighten the product balances somewhat. So maybe we'll start seeing a little bit better returns on the refinery margins in the U.S. I think I mentioned Singapore went negative the other day.
Hmm.
Um, and there, again, as we mentioned earlier, diesel is a big problem because the Chinese have been exporting diesel like crazy. and then diesel is moving into Europe on VLCCs, which is unbelievable because you got to clean the VLCC out to export clean products. So it still works for these guys. It's just
Right.
an incredible thing.
Yeah. So that's
So I think, yeah, I mean they've gotten battered here, these spreads. So maybe they can, you know, maybe they could rally somewhat. But if our balances come, if the IEA balances and the CRG balances, and I'm sure some of the banks have changed some of their balances. If we're seeing building inventory into the first and second quarter and into the third quarter, maybe, those they could go contango, some of these
right.
spreads.
Right. Right.
I don't know
Yes.
about super contango, but
Yeah, that's like I said, we saw some zero struck puts trade yesterday in the first quarter of 2025. So I guess that's what a lot of that's all about
yeah.
yeah, the storage play. Okay, good job, Andy. Anything I'm
Yeah, I
sure
have one thing. I
oh
do have
sure.
one thing.
Sorry.
I have one thing to add. It's not so much about the markets, but we're recording this on September 11th, a day that neither one of us will ever forget,
No,
since we were right across the street from the Trade Center. And I just think it's important to remember some of our friends and colleagues who are no longer with us, and also to remember all those firemen and policemen that we saw
yeah.
looking out the window. We saw these guys running into the buildings,
Mm.
and we know they never came out. So I just wanted to add that.
Yeah, I'll never forget, we were in the we were in the World Financial Center across the street, as you said, and came down the elevator. It was kind of waiting. We had to check the restrooms and make sure no one wasn't getting out. And so when I took the elevator, like, I don't think you're supposed to, even in the World Financial Center in emergency, but I took it down and I was on that escalator. There was no one, everybody had vanished. And there was a guy standing on the escalator in front of me. And, I just got behind him he was an older guy. He's probably younger than I am now, but I said, let's go, pal. We got to get out of here. And you kind of like just I went by him, went out the door towards the river. So I'm out of the atrium and I see a whole bunch of our EDF man employees coming around and they had just seen plane number two hit the building. And I'll never forget the horror on their faces. I mean, it was just holy. I've never, I work with these people every day. I've never seen them look like that. And then, yeah, it was just terrible, terrible. Yeah, I always feel it's a tough day to get through, even this.
Yeah, even 23 years later,
Yeah,
it's a
yeah,
tough day for us.
yeah. They said,
Um,
remember we had those social workers come down to visit with us. We moved our office into the Exchange building for a while temporarily, and then we moved up mid to Midtown. But we had these social workers, and they were saying the closer you were to ground zero, the more, I don't think they call it PTSD, but the more problems that they're seeing, basically. And and I don't know about you, but I feel like compared to other people, I got off really easy in terms of my situation down there. And yet very,
yeah, I feel the same way, but in other ways, as it's 23 years later,
oh,
we're never getting over that,
no,
Jim.
no, and that's right. That's right. So, uh, and then of course it would have been on September 10th, the president of our company dropped a risk report on my desk. We earlier in the year we had a an options market maker miss a margin call to us, which effectively means we own the position. and we worked with them to take the position down. And it wasn't working the way our president wanted it. So he dropped it on my desk September 10th. He goes, this is yours. Get out of it. Try not to lose another $1 million. And I said, okay. And then the next day was 9/11. So it was all these like, they were all options traded on the floor, but the bid offer spreads just, first of all, you couldn't trade for a couple of days. And then bid offer spreads were like blown out. A lot of them were product options. And then, of course, who the hell wanted to deal with this when you're dealing with all this other stuff going
Right.
on? Yeah. So
Right.
I remember you sitting next to me. Yeah.
Yeah.
Yeah. That was crazy. Okay. Let's move on.
Well,
So
that's it for me. You can find me and Andrew Lebow on LinkedIn, and I think we'll try to be back next month.
great, Andy. Thanks for your time. And I'm on LinkedIn as well. My next, well, we'll put this post up there. And then I'll try to put up an updated vol chart because I think they're always interesting. There's always a in each spike. There's a fundamental story to tell. So okay,